Welcome to ForexTV.com. Today's Thursday, March 12th. I'm Tim Kelly with your New York Forex Market Buzz. Dollar is stronger against all major currencies at midday as U.S. equity markets continue their advance and gold is up on the session. Now for a look at the latest headlines from the CEP news desk. U.S. continuing jobless claims soar, Swiss National Bank to intervene in currency markets, and retail sales better than expected. Retail sales in the United States were much better than expectations in February, with headline retail sales falling just 0.1% in February despite forecasts for a 0.5% contraction. Meanwhile, retail sales excluding autos grew 0.7% in the month against expectations for a 0.1% decline, that according to advanced estimates released from the Department of Commerce on Thursday. U.S. continuing claims soared to a new record. Continuing claims for unemployment benefits in the U.S. surged to a new record high of 5,317,000 in the week ending February 28th, well above the consensus forecast for a rise to 5,140,000, that according to the Department of Labor. The prior week's level of 5,106,000 was revised up to 5.124. Initial claims, meanwhile, rose to 654,000 in the week ending March 7th, following an upward revision to the previous week's claim to 645. Claims were forecast to come in at 644,000. U.S. business inventories down 1.1% in January. U.S. business inventories declined for the fifth straight month in January, indicating that businesses were cautious about the economic outlook to start off the new year. Inventories fell 1.1% month over month in January, 1/10 more than the consensus estimate for a 1% decline. That according to the U.S. Department of Commerce. The drop followed a revised 1.6% fallback in December, which was initially reported as a negative 1.3% from January 2008. Inventories are down 1.5%. Swiss National Bank to intervene in currency markets to weaken the franc. Central Bank of Switzerland lowered interest rates and said it would buy foreign currencies in order to prevent negative inflation. The unexpected foray into the foreign exchange market caused a massive sell-off in the Swiss franc, with the euro and dollar both jumping more than 2 cents against the franc in the moments following the decision. The Swiss National Bank lowered interest rates by a quarter point as expected and said it's acting to prevent any further appreciation of the Swiss franc against the euro. Canada posts first net asset position in at least 83 years. Due to years of debt reduction and a depreciation of its currency, Canada posted its first net international asset position since records began in 1926, that according to Statistics Canada. The statistical agency noted that Canada posted a net asset position of $13.5 billion in the fourth quarter, following a trend of reduced net foreign debt since the mid-1990s. The country's international assets rose 11.8% to $1.5 trillion in the quarter, while liabilities rose at a slow pace, up 6% to $1.479 trillion, that according to StatsCan. The result was largely due to a 12.6% depreciation of the Canadian dollar against the U.S. dollar in the quarter, which added $149.7 billion to Canada's international assets and $73 billion to its liabilities. Today we're joined by John Netto, Chief Investment Strategist at NetBlack Capital. John, welcome to the program.
It's great to be here. Thanks for having me on the show.
Well, John, just a quick word about NetBlack. Why don't you tell us what you do there at the firm, and then we'll get into some of the day's activities.
Sure. I'm a commodity trading advisor, which means I manage individuals or investors' accounts in a separately managed account structure. So within that capacity, we take on a number of viewpoints in the market. Myself and a colleague of mine actively trade in the futures markets and exclusively the futures markets. They could be currencies, fixed income, equities, both foreign and domestic equity markets, trade the Dow Jones Euro Stocks, the DAX, S&P, fixed income products, foreign currencies, and so we really get a sense from a global macro perspective of how to initiate strategies.
Okay, John. Well, we certainly could use your expertise today. There's a lot going on here. I'm going to throw the ball in your court here. The SNB made some stunning moves here, and I think that set markets on fire here. So we've got some big moves in sterling, big moves in yen, a little bit of a quandary in yen. But I'm going to throw it in your court and ask you to give us a quick assessment from a macro global standpoint, because we have a lot of global news out today.
Sure. One of the things that I like to chart is I chart unconventional ratios, markets against each other. We've seen a lot of talk recently, in particular on some of the major financial networks yesterday, that gold in the S&P have become an inverse trade. And if you actually look at the chart of that, that's not necessarily the case. When we see gold rallying, which is typically regarded as a component of fear, or what people will begin to hoard in times of fear and whatnot, and you look at the S&P, they've actually kind of moved pretty well together today. The gold's up $14, $15 in the day right now. As I look across the coast, the S&P is not too far off highs right now, and that to me is more indicative of one, short covering, but two, maybe some potential inflationary concerns seeping their way back into the market again. Some things when I look across, I like to analyze some of the forward curves on some of the commodities out there. Looking at crude right now, we've seen a flattening of the short-term forward curve, but still a pretty steep longer-term curve, meaning like 12 months to 2 years out, 3 years out. There's still quite a disparity between, let's say, the DSO9 crude contract and the D2014 crude contract, which may be a trade opportunity in and of itself. But overall, though, I think that there's a cinder block scenario for shorts to come in and cover, and you obviously, the aforementioned economic data you put out there, it creates a great dynamic to look at and trade.
John, so let's get specific at this point. Let's start off with euro right now. Just a data check at 128.08. That traded in a relatively tight range of 127.32 to 128.71 overnight here. What's your take on euro right now? Seems to be a little bit of decoupling from its equity relationship.
Well, I think the euro just encapsulates what's going on a number of markets right now. There's a little bit of, it's not that there's like a greater risk appetite, but there's less of a risk-averse appetite. And that component has helped the euro rally today. It's helped the equities rally today, because we just came off of a very successful treasury auction for the 30 years, and despite the strength in the fixed income side across the yield curve, we're still seeing strength in the equities and in those currencies as well. So that decoupling you talked about, I think, is just one of those dynamics that within a vacuum of one single day, you can see this happen from time to time.
Okay, so let's move from there. Again, a risk appetite issue here. Dollar yen, we've seen a move of probably three big figures there, traded down to the 95 range, and then quickly shot back up. A lot of folks thinking that we've come too far too fast there. What's your take?
I think it's a great call in terms of obviously we're sitting down at 90 to just a few weeks back, and a very precipitous rally in the USD JPY. Came pretty darn close to parity, have now pulled back, and the trend in USD JPY is clearly up. And using the pullback in that rally, the new people came in, new traders came in to initiate long positions again. There's a number of economic issues facing Japan, and the yen has really backed off of being the risk-averse currency, and it's really become more about the underlying Japanese fundamentals and economics, and that sentiment is what's pushing that currency, or that cross around right now.
What's your outlook for yen in the short term, the next couple of weeks?
I think the yen itself is vulnerable against a number of crosses out there. In particular, the USD JPY is going to come and test parity again and probably hit 103, 104. And then from that point in time, we'll probably settle around parity for the next couple of months. I think the currencies in general have seen a compression. I know that they've seen a compression in implied volatility numbers if you trade into the currency options out there. And I think that this cross here will probably settle around that 100 level, and across the board, even with Aussie dollar, with Euro, US dollar, all of those guys have taken on more of a range-bound component. The yen being the exception to that, but I think it's probably going to end up somewhere around the parity level, because it still is a country that does have some underlying, as far as the debt that the Japanese have is not quite as exhaustive as some of its other nations out there, and it still may catch some risk-averse capital.
Hey, John, you mentioned Aussie. Aussie used to be a place to get some carry trade benefits, and
sure,
that's gone away. But a lot of folks saying that Aussie now is all about trade, and with Chinese imports down, obviously China the biggest importer of Australian goods. How does that bode for certainly trading within a range here? But you think we're at that 64 range, 65 range, can't really break too far above that, it seems. What's in store for Aussie?
I think more of the same for the time being. In terms of Chinese imports being down. I think the Chinese trying to predict the Chinese economy is very enigmatic insofar as all the variables that come into play there in terms of how they repatriate their dollars from the U.S., what they're doing with their global investments, how their gold reserves and whatnot, how they're accumulating that. In terms of that, what are their relying on more domestic sources in terms of resource generation. And so I'm hesitant to speculate on the Chinese-Aussie dynamic, but I think when you look at that cross, you look at the Aussie cross a bunch of number of pairs out there, you really have a market that is sold off rather hard, and this is typical of you look at over the course of history these big market sell-offs, and it's now gone into a flattening base-building range. And so those markets are less conducive for active traders like myself, and covering as many markets as I do, that's one that I'd stay away from, because if there's no clear signal, maybe the USD JPY is in much more of a trend, whereas the Aussie USD is much more consolidation and hard to predict.
Sure. We've seen that in the past couple of sessions. We seem to hover around this point for a couple of weeks now. One other mover today, sterling. Maybe give us your thoughts on sterling. Just a quick check. 138.31. That traded in about almost three big figures as well. Maybe 2.5 closer. Range of 136.99 to 139.19. What's your take there?
I think longer term, the trend is down. It wouldn't surprise me if, of course, the next 12 months we end up getting, sterling trading at parity with the U.S. dollar, as drastic as that might sound, because of what's taking place. I think that shorter term, it's a chart that for those of you that believe in taking longer term positions, i.e. several months at a time, that has to be compressed almost to several days at a time because of the percentage moves that cross can generate. And I think that, from a short term standpoint, bid into the moves as long as it's holding above certain levels, and then when that begins to roll again, I think it's like this. The longs with sterling you need to be very nimble with. The shorts with sterling you can let move a little bit as far as selling rallies.
Okay, so now with that out of the way, John, let's talk about Swissy. 4 big figures today. Obviously, we know why. Interest rate cuts, intervention by the Swiss National Bank. What's your take on dollar Swiss at this point? Trading right now, we're trading at 119.02 off the session high of 119.66.
Again, when you get these major catalyst moves like we had this morning, I kind of wait to see how. Let the guys that really understand all the machinations between that cross come in and push the money around, and then once that settles, begin to play the trend from there. I can't. It's not my style to extrapolate that data immediately and try and make a move off that. But I think longer term, when you look at the strength of the U.S. dollar in terms of how it's done against that in that respective cross there, that it's a move that I think the dollar will continue to rally against that cross.
Okay, John, we're going to leave it there. Thanks for joining us today.
Thanks so much.
This has been your New York Forex Market Buzz with John Netto of NetBlack Capital. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.